Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee, and joining me on this show is a long-time thoughtful observer of the Indian market, Sanjay Mookim, who's now the India Equity Research Head and Equity Strategist at JPMorgan. Sanjay, it's very good to connect with you after a long time. I've been reading your notes, and you've been striking many notes of caution in your recent strategy reports. So perhaps you could begin by telling us what makes you cautious about the Indian market from now.
Hey Udayan, hi, it's good to be on. Well, there are multiple things you can say about India and Indian markets, I would argue. If you take a slightly longer term view, say you have the patience to be invested for 5, 7, 10 years, then there's a lot going right for the Indian economy. Structurally, there are things which are improving, and we have done research at our end as well to highlight what several of these are. The manufacturing drive, the urbanization that's happening in the economy, the digitization that is driving upskilling and so on and so forth. And there's multiple sort of positives that you can potentially highlight. However, in the near term, and this is our firm belief, that stock markets do discount what is happening in the near few quarters. In the near term, there are risks that are accumulating on the horizon. And 2 or 3 of these, if I may talk about just to begin with. One, of course, is that the market has been stronger than its peer set across the world. And this is a very strange thing to say that, look, YTD, the Indian market is actually flat in INR terms and down in dollar terms, yet it appears to be one of the best performing in the world. And that's probably a reflection of the challenges that other economies have faced. But the effect of all of this, Udayan, is that India now trades at a significant premium. Even to the S&P 500, for example, we are at a 10-year high PE premium, while the growth premium is at a 10-year low. And on various valuation counts, India looks particularly extended at the moment. The other sort of issue that we worry about is the external account risks. Right? We've seen how reserves for the country have fallen. We see the potential for liquidity to remain tight in the country, and that could drive credit spreads in India higher still. And that the local growth is actually weaker than we think. So these are the 2 or 3 things, combination of high expectations, high valuations, while the macro risks are accumulating, makes us a little bit cautious on the outlook for Indian equities in the next 12 months.
Your point is taken about this relative outperformance, Sanjay, and there has been a lot of talk about it. I mean, there are people like you who've turned cautious because of this relative outperformance and, of course, the premium in valuations. And there are others on the other end of the spectrum who've started to talk about the possibility of India emerging as an asset class on its own, and therefore not necessarily being hamstrung by relative outperformance compared to the S&P. But where do you stand on that debate?
Well, there is an argument that it should happen. Whether it is already happening is I not very certain of that, Udayan. And frankly, the debate to have is if it does become a standalone asset class, and I do think it's way too early to argue that. If it does become, then can we absorb the sort of flows that would entail? I don't think so. The liquidity in the market, the free float availability in the market is not large enough to become decoupled from EM, for example. Maybe China becomes an asset class of its own, given what it's doing at the moment. But to argue that India will also become one of that, I'm not so sure. What I do notice in conversation, Udayan, is that there are several funds who are talking of EM ex China strategies, in that that would involve India being high double digits weight in that. But India as standalone, I would think it's probably too early.
And you don't believe that this kind of decoupling, I mean, decoupling is a strong word, but the kind of divergence that we've seen between the Nifty and the S&P, but this can continue for very long given historic metrics or even growth metrics?
So that's where the debate actually centers, Udayan. Because yes, the markets have decoupled, and to everybody's surprise, frankly, but the economies are not. Right? And that is the conundrum, because India does feel the heat from high oil prices. In fact, if you look at the last 12 months, coal prices have been a bigger driver of deterioration in current accounts than oil has been. Similarly, you have pressure from fertilizer, palm oil, and so on and so forth. So everything that you expect to happen as a consequence of high commodity prices is happening. Reserves are falling because dollar inflows are stubbornly negative, right, and will likely remain the case. So on an economic basis, there is no decoupling at the moment. The markets probably looking at something beyond the near term is decoupled for now, but something's got to give. Either the economy comes back and delivers, surprise, or the markets will have to catch up to economic reality.
And this problem of on the external account front that you've alluded to a couple of times now, but do you see that filtering through to the stock market at any point in the near future, or do you think it will actually wreak some kind of damage on the Indian currency, the signs of which are already quite manifest, but the stock market might not get roiled so much by the external account issues?
So the transmission mechanism that we have been worrying about is that if the rupee were to depreciate further, it already has moved in the last few weeks, but if it were to continue to slip, then the RBI will have to, by corollary, tighten domestic liquidity further. So overnight surpluses have been reduced significantly, but one of the problems in India is that the credit spreads locally are much lower than credit spreads in the region. If you take the same corporate, onshore bond yields or the spread of the onshore bond yield to the regional bond yield is the lowest it's been in several years. And this is a problem because unless interest rates in India rise as well, and for corporates and actual on the ground rates rise further, you will continue to see capital outflow from India. Okay. So the RBI, if you get continued rupee depreciation, might have to engineer further liquidity tightness in the country, and that would have an impact on equity markets. So there may be still time and to be fair, and let me qualify, we are not in a crisis situation. This is not like 2013 by any stretch, but we seem to be heading in a direction where the RBI may be forced to tighten domestic liquidity more than it already has.
Now, one offset, of course, could be if suddenly the global mood on India changes and we get a gush or keep getting periodic gushes of equity inflows, dollar inflows. But do you think the global backdrop is such that that should not be the base case for the next 1 year?
Right. Now, this goes back to your earlier question whether India will become a standalone class, Udayan. As of now, we are not. If you look at the performance over the last 4-5 weeks, when we did get a little bit of dollar inflow into India, that was accompanied by inflows into all Asian economies, China included. So it was not an India-specific turn inflow, it was a region turn inflow. And that is why it becomes important, I think, for us as an economic sort of outlook to see better China data, because the flow dependency on India is still hooked to EM, and if you see China reopen, numbers out of China start to look better, will you start to see pressure on EM currencies go away, but more importantly dollar inflow into EM, a portion of which will come into India as well. So for all, from a macroeconomic point of view, I think it will be great for China to reopen, for data in EM to look better. Yes, India will probably underperform if China starts to rebound, but from a flows perspective, that is what we want.
This is actually quite different from what a lot of other people seem to think, that China's loss will be India's gain, that if China actually does not do well as an economy or as a stock market, India will benefit from flows from foreigners. You're saying that is not the right way to look at it. If China does well, then we will actually be the beneficiary of flows coming into the region. It's the opposite.
That's right, Udayan. And this is because that whole premise that India has a decoupled flow does not bear in data so far, right? And we are getting only shares of flows that come into the region, not decoupled flows just yet. So, and the only way we get far more significant volume or quantum of flow is if that money comes into EM baskets, of which we get a certain share. Right? And that's why from a flow perspective, it's actually great for China to reopen, I think.
So let me ask you how you think this will pan out. I mean, if your view is cautious for all the reasons that you've mentioned, do you expect prices to adjust now so that to address some of the valuation issues that you just spoke about, or could it be a long protracted time correction? The market just goes sideways. Last 1 year has been flat. Maybe we go through another flat year and let earnings slowly catch up. What do you think is more likely?
So this brings me to the second sort of theme that we use in communicating with clients, Udayan, which is the driver of stock prices, right? And it's a very fundamental question, but our quantitative analysis points very simply to the fact that stocks move on earnings surprises and earnings disappointments. Yes, if you're a private equity investor, earnings growth over 3 year or 5 year is your friend. But if you're a shorter term investor, it is the surprise element in stocks which seems to matter far more than just growth. And if you look at the trajectory of potential earnings growth and misses, while the September quarter we may get away with reasonable growth and probably living up to expectations to some degree, especially because Diwali is in October. By the time you get to the December and then the March quarters, you will see a significant deceleration in the reported growth numbers for many companies because base effects will catch up, and we argue that in many cases you will start to see earnings disappointments as well. So if you look at the path for earnings momentum in India, it looks likely to roll down getting into December and March. So the bias for me, and this is very difficult to predict of course, but the bias for me to suggest is that for many of the favorite growthy expensive stocks, you might actually see a price leg down getting into December and March.
How much of a price leg down are you expecting, Sanjay? I mean, from the reports that I have read of yours, you seem to suggest that a 5-6% kind of a price adjustment will not be enough to bring India down to long-term averages in terms of valuations or premier differences with other markets. Would it be fair to say that even a 10-15% kind of correction from these levels would not surprise you?
Well, you're putting me on the spot there a bit, Udayan. This is extremely difficult to predict, but quantitatively a 5 or 6% correction in prices will not get you down to average P's by any stretch. There are several companies which are retaining up to 40-50% PE premiums from where they were pre-COVID, right? So forget the long-term average, just the December 19 PE. There are several stocks which are 30-40% more richer in valuation. And you could argue that, look, if the whole world is normalizing, rates are normalizing, the economy is normalizing, why do these multiples retain those kind of premiums through COVID? So tentatively, 5 to 6% is certainly not enough to justify turn in valuation arguments.
And I mean, I know of all of this is very difficult to predict, but since you spoke about the December and the March quarters, do you think that most of the price damage in India will happen, say, before the start of the next financial year? Because the other fear is that we drag on or amble along, and then sometimes maybe towards the middle of next year or the latter half of next year calendar, we get a sense of how deep the global problems may be, and therefore this turns out to be a more protracted down cycle in asset prices rather than a short price hit for over 3-4 months, which is then a buying opportunity, and then things start to improve. Of these two scenarios, which one do you lean towards?
So I think that is the more critical debate to have, is how bad the global tightening or how long the global tightening cycle is likely to retain. If you think about how expectations have changed just over the last 12 months or then, people were talking of a few rate hikes at best that got increased to a policy forecast of 3.5% and done. And now people are forecasting or penciling in 4.75 to 5% of Fed's policy rate and then staying elevated for longer as well. So there has been a sudden recalibration of the extent of tightness that global central banks will have to engineer in order to bring inflation under control. You would want to suggest that at 5% or 4.75 policy rates will peak out, and yes, you will not see further tightness thereafter. But these things have become very tricky to predict, especially given the global geopolitical uncertainties that you are currently living through. If you do see, let's say, rates peak out at somewhere 4.5-5%, one, you may still get asset price correction because I don't think assets are pricing in that kind of a policy rate or long-term interest rates. But beyond that, hopefully you could start looking at the positives of a recovery or growth. India is certainly by no extent pricing in a 4.5-5% policy rate in the US for that matter. So ideally you should see on valuations a sharper correction in India to make sense. But the argument I make to investors as well, Udayan, is that, look, if you do take that view that the world in 12 months will look better than it is today and many of the uncertainties will have disappeared, then there are many other regions in the world where this risk has been priced in properly. India has not priced in the risk yet. So if I do take a positive view, then there are many other asset classes or equity classes that I would like to look at more favorably than India.
You spoke about the December and the March quarter probably leading to earnings disappointments, but many of the factors, or the principal factor for some sluggishness in earnings in those two quarters could be the base effect, as you mentioned yourself. But the base effect is not a surprise. The base effect is known. So are you therefore suggesting that even adjusting for the base effect, we are in for earnings disappointments as we look past the Diwali quarter?
Yes, and that's the fear. So you are exactly right in saying that these base effects are arithmetical and they should not drive prices. That's just an optical phenomenon there. But what happens is that analysts do tend to get carried away with the strong growth numbers that are being reported now. And we argue that with the base effects, reported numbers will slow, but more importantly, you will probably see earnings misses. And one of the core arguments we make is that if you look at data over the last 10 to 15 years in India, Udayan, every time prices go up, volumes of sales of discretionary goods take a hit. It is invariable, right? It has happened in every cycle. Inflation leads to lower consumption. It is very intuitive economically as well. We will probably start to see it post the festive season, where this kind of price inflation in an economy which is not seeing very strong real income growth will probably lead to consumption volume slow down to some degree. And that's why you will likely to see earnings misses and cuts irrespective of the base effect, and that could weigh on prices.
Traditionally, if you're right in your call on the market, traditionally what would do well are defensives. And the classic defensives in such downturns have been mostly the IT and the FMCG companies. Good management, good balance sheets, ability to weather shocks. And we saw just a few years ago how narrow the market had become in a difficult phase. It was a bunch of 20 or 25 stocks which just kept doing well. Are you expecting, before you answer any questions on specific sectors, do you expect the market to turn as narrow as it had become in 2018 or 19?
Well, I hope not for all our sakes, frankly, because then we'll have very little to do, very few recommendations to make. But the likelihood is that it might, because the breadth of surprises is likely to narrow. To your point earlier, Udayan, and we've done the empirical analysis, in such macro conditions when liquidity is tightening, the rate, currency is moving and so on, the three sectors which have tended to do well, the traditional defensives in India, IT, staples and healthcare, right? We are not that gung-ho about IT, and we can talk about that subsequently. But these are the sectors that tend to do well. If you remember in 2018, as you said, you had such a narrow market that if you owned 10 stocks, you outperformed. If you owned 15, you underperformed, right? The breadth of earnings revisions is likely to get narrower. Therefore, the risk is that you might get a narrower stock performance basket as well.
Okay, let's take it one by one. Let's start with staples. A lot of people are not very bullish on staples, particularly at current valuations. They say that at the bottom of the pyramid, demand is still not very strong, and as prices rise higher, it may squeeze that part of the market even more. Do you think the defensive characteristics of FMCG will prevail over these concerns, or do you expect it to be a market performer at best, these stocks?
Well, staying true to my framework of looking for earnings surprises, Udayan, at least in staples, I'm not looking for too much of an earnings miss, simply because expectations are not very high. So when I talk of surprises, you're always talking about relative to expectations or what the consensus earnings forecast numbers might be. And given that staples have already been through, let's say, 2 or 3 quarters of weakness, expectations have been set down to what I would think are realistic expectations. The upside risk to earnings possibly comes from lower input costs. Palm oil prices have come off. These companies have taken price inflation. So you might get either a margin surprise or a bit of a volume surprise in these numbers. But at least the downside risk to these numbers seems to be fairly limited to my mind, which is why I think that, yes, they should be defensive in a market that does not do terribly either way in the next several quarters. To flip that, and anticipating probably your next question, is consumer discretionary. Not only are they growing, but the expectations of growth are super high. Right? In an environment where price inflation is high, which could hurt volumes, the bias is to say that for the discretionary stocks, you might actually get a little bit of an earnings miss.
Which brings me to IT. Of course, we all know about the global headwinds there. But given that these stock prices have been underperforming, do you think current valuations price in some of the risks that are there, or even from these prices, you cannot make a very bullish construct?
So to some degree, the multiples have compressed. But if you look at the large cap IT, then they're still trading at premiums to where they were pre-COVID, right? December 19 being my benchmark, for example. Between 10 to 20% PE premiums still exist in many of these IT companies. A lot of people have become worried about the impact of the US potential recession or what's happening in Europe on the top lines for these companies. But you've not seen the management come out and acknowledge it publicly. You might still get the event of turn down in management tone on top lines. Yes, margins has been, or the concern on margins have been fully understood, but the top line or the extent of top line weakness has not yet been digested fully to my mind, and the valuations despite the underperformance are not there yet, which is the reason why we, despite talking about potential risks to the currency, we are not very overweight on IT in our model portfolio.
Sanjay, great talking to you. Excellent thoughts, and thank you very much for taking time out for me today.
Always a pleasure, Udayan. Have a great day.
If you like the video, do like, comment, share and subscribe.